Hey, happy Monday. Hope everyone had a great weekend. Just starting off with your market update. Unfortunately, I wish I had better news to give, but mortgage bonds already started the day down 27 basis points. We had some more news last week that just keeps pushing us further into lower bond price territory and higher rates, unfortunately. We do have a lot of eyes on Wednesday this week, where we do have the Fed meeting, Fed announcement at 2 o'clock, and then we've got Jerome Powell's comments at 2:30. Hopefully, those are helpful in some way to swing markets the other way. I'm certainly not counting on it. I feel like we've got a 75 basis point hike pretty much already priced into markets. I think it's really going to come down to the verbiage and the comments that come out of the Fed on Wednesday that are going to really show how the markets are going to react. Just to dive into the numbers real quick, if we kind of look, we see a pretty definitive trend line here in mortgage-backed securities. That just, I mean, we've been getting pummeled, plain and simple. So the real hope here is that some of Wednesday's commentary can turn things around. We'll see where we end up. Also, we're looking at the 10-year Treasury right now for everybody kind of following along. The higher the Treasury yields go, the higher interest rates go. So obviously, we'd love to see these yields come down in terms of interest rates. But I mean, you've got such a clearly defined trend line here, and this level of resistance right around 3.5 on the 10-year Treasury. It'd be interesting to see if we bounce off that or if we clear it, because there's a lot more room to the upside or downside, depending on your point of view. In terms of where this is leaving interest rates on your conforming loans, you're looking somewhere from 6.25 all the way up to the 6.625, 6.75. I mean, we're living in the sixes now, and it came really fast. And hopefully, we don't spend a whole lot of time here, but it's where we are right now. On your government loans, fortunately, these price a little bit better. So we're somewhere between the 5.125 all the way as high as kind of creeping into the sixes to 5.75, 5.875. So again, the benefit here as a broker, we can kind of shop the market and pick the best rates available from the marketplace. But they're all pretty brutal right now. So that's where we stand. I think we're really looking at Q4 for some better news and into Q1. When we see the inflation data that comes from October, which will come out in November, early December, if I'm not mistaken, that's going to be important to see if these Fed rate hikes are starting to really impact the economy on a meaningful level. I mean, we're not talking about, flash in the pan inflation. This is the worst inflation we've seen in 42 years. So, it is a big deal, and it's obviously not something that's going to go away in a quick flash. It's going to take a little bit of time. But hopefully, again, the Fed can convince markets on Wednesday that, we've got some things under control. Economic news also coming out this week. It's going to be a busy week. We've got existing home sales for August on Wednesday. That's going to be a big number. Obviously, we're expecting the media to really make it sound as doom and gloom as possible, but I do think it'll be a good insight into where things are and if that wave of inventory that we've seen come up is starting to crest just because of the seasonal nature of our market. Again, we'll kind of see how that plays out, but that's where rates are. That's where markets are. Hope everyone has a great week. If I can do anything to help, feel free to call me anytime. Take care.